Hello and welcome back to HealthTech Hour on UK Health Radio. My name is Steve Roest, and every week we'll be bringing you the best guests and interviews with the people shaping the health technology landscape in the UK and beyond. I'm a CEO and founder in the health tech industry myself. I have nearly 20 years of scaling venture-backed technology companies across the world, and I am passionate about the people and companies who are changing the world. To keep up to date with the show, please follow us on @HealthTech Hour on Twitter and Instagram, and also make sure you follow UK Health Radio, which is @UK Health Radio. So as an introduction to my next guest, who I'm extremely happy to have on our Christmas show, for those of you watching this on YouTube, you'll see that I'm wearing a lovely Santa hat, and Peter, my guest, is wearing a quite phenomenal Christmas jumper with a light up Santa Claus on it, which is excellent. So my current company, Vital Signs Solutions, has developed a digital platform called PocDoc, which allows anyone with a smartphone to give themselves a blood test for a range of major diseases using just their smartphone. This is a very nice introduction to Peter, because in the interest of full disclosure, Peter is an investor in our company and actually on our board, which we're extremely happy about. So Peter Cowley, who is going to be speaking in a second, is, I would imagine, one of the most prolific angel investors in the UK. He is the owner and founder of investedinvestor.com. He is an author, multi-time author. He has mentored hundreds of startups, some in the health tech space, some not in the health tech space. And in addition to that, he is a phenomenal entrepreneur himself. So Peter, welcome to the show.
Welcome. Yes, hello. Thanks for the introduction. I should just add, there is another connection as well. Your wife was at my first wedding when she was 9 months old.
I heard that. I did hear that.
Quite unusual. That does.
I know. I've heard that story many a time, because my wife takes it as a personal affront that she was kept in the car and not allowed in the pub.
Yes, if anybody knew the landlord of the place that we had our wedding meal, they'd understand why. But that's a very long story and a very long time ago, of course.
Yeah. Although, I'm not sure my wife would welcome us naming the number of years ago that was when she was 9 months old in the car.
Yeah. Okay.
But yes, exactly. There's a lot of connections. So how are you at the moment? Which tier are you in? What are the restrictions?
Yeah, so I'm in Cambridge. I live in Cambridge. I was brought up in Yorkshire, in Hull, and came to Cambridge University, obviously a long time ago, and left, and then went to live in London and then Bavaria and back, and brought the kids up in Stamford in Lincolnshire.
Okay.
I came back to Cambridge about 15, 17 years ago. So yeah, this is tier 2, which means I've actually we had this help out to eat out in the summer, and I've sort of indirectly been doing that recently, because I worked out last night I've been out to eat 9 times in 9 days.
Wow, that's some kind of record.
Mostly work, I will say, so I was keeping within the rules where I could. So it's very different. I've got a close friend who's literally 200 meters in tier 4 from tier 2, which is
really,
yeah. So when he goes out cycling, he may well sort of accidentally end up in tier 2.
Yeah, it's amazing. I mean, I haven't checked, but is there an easy sort of piece of technology or an app to check where you're moving between?
No,
or is it very
there has to be boundary, obviously, and it can't always be a river. In this case, his boundary is one side of the street's tier 2 and one side's tier 4, and that will be happening all over the country. There are all kinds of, there's nothing one can do about that. So it's based on county boundaries generally, and therefore and that's the way it is. So yeah, I'm sure people are not behaving quite as they should, but the point is, the more they can behave, the less likely the spread will be.
Yeah, good. Well, look, thanks for coming on the show for the Christmas show. The format of the show, which, based off of one show, this is show number 2. We stuck to it reasonably well in show number 1 with Bridget Bard, which was a great show, talking to her as the founder of BioSure and the world's first developer of an HIV self-test, and the world's first developer of a COVID-19 self-test, which was super interesting. So the first bit of the show is origins, how you got to where you are, sort of your sort of path, I guess. Then the middle bit is around what you're doing, and specifically with you, I think it's going to be really interesting for our listeners to hear about investments that you've made in the health tech space, your view on health tech from an investor perspective, but also your experience having mentored, literally hundreds of companies now, and entrepreneurs on their journey, and as to why there is a difference. As a health tech founder and an entrepreneur myself, I perceive there to be a difference between health tech and other forms of tech that people are, more familiar with, sort of startup life. And then the final piece is around your thoughts about the future. And we can kick around a few topics of the day that may relate to COVID. Hopefully we can try and find something that isn't related to COVID to talk about to kind of freshen it up for everyone listening. So let's start there. So how did you, I mean, you've been you were an entrepreneur first and then you were an investor, but how far back would you like to go in terms of where you feel like your journey to where you are now began?
Yes, yeah, I still class myself as an entrepreneur actually, because I've still got a couple of business, a tech business and a publishing business, but they're both lifestyle businesses. Whereas over the years, I've scaled businesses.
How would you, for the listeners at home, how would you describe a lifestyle business?
One where, well, there's some very big lifestyle businesses. It could be argued Richard Branson's empire is a lifestyle business, although some of it's quoted, obviously. A lifestyle business, I doubt there's a natural definition, but as far as an angel is concerned, i.e. we invest in businesses that are going to scale rapidly, and we can probably, in many cases, force them to overscale and maybe to failure, which is something that's, because it's certainly true that the big majority of startups that fail, that had external investment, fail because they run out of cash. And why do they need the cash? It's because they haven't got enough customers. And what is paying the bills? It's the investors. So if the investors stop investing, the bills don't get paid and it failed. So in terms of, so a company that hasn't got external investment is basically run and controlled by the founders, and maybe some help from the bank. And so in principle, that is a lifestyle business because they can run it as their own lifestyle. So you will get businesses that are angel invested that become lifestyle business, and that's something we have to watch and avoid because we want to get out at some point.
So let's just break that down because people listening may not necessarily be so familiar with the concepts that you're talking about, but really in the one instance, if it's a lifestyle business, it means that the founders, the people that started the business, can run it how they want to because there is no requirement for them to seek external capital.
Well, there's no pressure from external capital that's come in.
Right.
That way around.
Right. Yeah. Okay, cool. So
there's nothing wrong with the lifestyle business. Of the 5.8 million businesses in the UK, probably 5.6 or 7 million are, or except for a few 100,000 of them, are lifestyle businesses. Right. And this, it should never be regarded as a negative thing. It sounds negative, but it's not. Whether it's the local shop or it's the graphic design agency or it's a company that's got 2,000 people somewhere. Don't take that negatively. But it isn't the sort of thing that angel investors or any investors want to get into because we want growth. So we can have decent returns, which will offset all the other failures.
Yeah, because it's a portfolio.
Yeah. So I interrupted the question.
Yeah. Let's talk about where you are.
Let's start
immediately to where you are.
Yeah. So to go back to, I won't go back into the past, but engineering, computer science, a bit of corporate life, which I think is very important. I will only, well, not only, but I almost only will only invest in people, young people who've had some corporate life to understand what people politics are about and processes and everything, rather than just straight out of university. And then I went out to Germany, and within a year, the business I joined as an employee had been sold to somebody I didn't want to work for, so I set up my first business back in 1981.
Okay.
And
what was that business?
That business was as common, was basically a copy of the previous business.
Okay.
It wasn't owned by the big corporate, so they bought it for their own reasons. They stopped selling externally, so we took over basically some of the customers, redesigned the tech, was a bit out of date, etc. So it was providing user interfaces for industrial manufacturers. So Bosch and Siemens and BMW, some of the big names that were using stuff on the shop floor. This is 40 years ago, so technology's moved on a long way since then.
Yeah.
That sort of thing isn't used any longer. Anyway, so I was a co-founder of that, and then back in 84, I came back to the UK because we had a kid and things were different, etc. And set up CamData, which I still have after 36 years.
Yeah, and what does CamData do?
CamData's done a lot of things over the years. The naming of the company was Cam as in Cambridge and Cam as in computer-aided manufacturing.
Okay.
And it morphed ups and downs. It went bust once, and I bought it back again, and then I sold it to another company. I bought the company. I sold it to. I bought one of the competitors. But it's basically round numbers. It's about €100,000, £100,000 revenue, making profit, just doing some stuff in the traffic light industry at the moment.
Wow.
You know, we've all got our own little niches around the place. It's
Wow.
on the website. Anyway, so did that for a while, and then I moved into property development and built some houses. So that's where I made my initial capital to get to angel invest.
Okay.
I've done some, I've over a dozen businesses I founded or co-founded, and some in B2C, business to consumer, some business to business, some business to business to consumer. So I've had lots and lots of experience. Anyway, let's move forward a lot further.
Yeah.
Oh, just one other thing. I've been involved on the governance of a number of charities, 7 different charities, many of which I've been. So I know quite a lot about charities and to some extent social enterprises.
Okay.
Move forward to about 12 or 13 years ago, I invested in a business that I was mentoring the guy who'd done computer science here in Cambridge, and we sold it quite quickly. And during those 2.5 years, I made 17 times my money.
Oh, nice.
A small amount of money became a little bit bigger amount of money, obviously, but nothing special, nothing life-changing. And during that process, I found out what an angel was. I thought, I actually really enjoy this. The concept of helping younger people, of which you, Steve, are obviously, and your wife, and giving money in which produces a multiple. Now, I was not completely naive. I knew that this wouldn't always be the case. I'd get 17 times my money every time I put it in. Otherwise, it couldn't happen. So I joined a group called the Cambridge Angels, which is a business angel group here in Cambridge. It was set up about 20 years ago. And that's been so key to my journey, because I've learned everything I have from the people who've been doing it before.
So just to go back, were you investing during the first .com boom and crash? No.
Well after that, I was in fact, even after the Wall Street banking crisis,
the financial crisis.
Yeah, exactly. So I invested in the startup during that period, but the first investment I made that was not the one that got me on the journey was in 2009. So, so in that respect, I have not seen a big reset of values, which we may have time to talk about, which is or probably will be or is happening at the moment.
Right, because of COVID.
Too hot, exactly, because of changes in both in terms of the process of investing and the macroeconomic effects or global economic effects of what's going to be happening down the line.
Okay. So what was it that got you in, what was it particularly that inspired you? Actually, before we carry on, do you actually have a headset? Because I'm slightly worried about your sound levels as I look at this.
No, I don't.
Okay, well, we'll just...
I've been on this setup now for 9-10 months during Zoom. So I'm
perfect. I'm sure it's okay.
Inshallah.
I hope Station Master Johan can make it work. So what kind of moved you after you did this initial investment? What was the business, by the way? Not the name if you don't want to release it, but what was the area?
No, I don't have a problem with that. It's called X Computing, EPT Computing, and it was a service business to start with, morphed into a product business called Go Test It. First customer, interesting story, the first customer actually was one of the co-founders who left. And something about 20% of all their businesses, founders or co-founders have left. And that's a very painful process, and it was painful. So that was the first learning step. And it morphed into Go Test It, which was a browser-based testing of software.
Go Test It, so actually
web-based. Long gone. I mean, it was sold to a software company here in Cambridge. So that doesn't really matter, apart from something we'll come to later, that I and other angels, busy angels, invest in things we understand, which we'll soon find out. I don't understand as much about health, life sciences or health tech or whatever we're going to call it. So I invest in less of those because I'm not a biochemist or genomics expert, etc. So yeah.
Why, just for everyone listening, why are angels called angels? Where did that term kind of come from?
It came from the middle of the 19th century, when if somebody wants to put a play on, they needed to rent a theatre. This is a big play, as in, Central Shaftesbury Avenue or in New York or Broadway. They needed to rent the theatre a bit beforehand, buy the set, pay the cast and everything. So some money needs to go in. So they went out to, people who had money and said, can you can you buy equity in this production? Right. And I'll promise, inverted commas, to pay it back times a multiple. So people will put money in, then say the play's a flop, and closes after the first night, which does happen. These investors lost everything. Or
Right.
say in the UK, it's the mousetrap or something, which has been going for 60 years. Obviously, these investors, if they still own part of it, have made an absolutely massive amount of money. So they're called they're called angels, and that became sort of theatre angels. And the business angels, of which we usually call them angels, term was coined probably in the 70s in California.
Okay. Right. Yeah, because it's now, I mean, these concepts of angels and investors and, you know, startups has just become a much, much greater part of the ongoing discussions in society. I think the vocabulary is now sort of becoming a lot more sort of normalized. So what would you say the key lessons are that you've taken from your world of work or your entrepreneurial experience that have, you know, lessons, behaviors that you've retained throughout your, you know, your career and all of the different things that you've done? Have there been some consistent things that you recognize that you've always done or that you always try to do?
Yeah, that's good. No, well, I've never been asked that before, so I'm not.
Oh, well.
So
look at that. You've been in many interviews. I've asked you something you've never been asked.
No, the questions usually are, what did you learn as an entrepreneur? What did you learn as an angel investor? And so on. But to actually say what characteristics or traits that I've done all the way through. And there probably isn't anything specific because, you know, I've adapted. I spend a lot of time thinking, reflecting on changes. You know,
self-improvement.
Into life 4.0 at the moment, which will be some change, and I'm going through that transition at the moment. You know, a lot of people would call that retirement, but I'm not really retired. I enjoy what I'm doing so much. The big one, which took some time to recognize both as an entrepreneur and then as an angel investor, that in the end, it's all to do with people. It's not really to do very much else at all. It's having the right people as employees, backing the right people as entrepreneurs. And in the end, it's just the wrong people can take a great idea and completely ruin it. And the right people can take actually quite a poor idea relatively and tell you something good.
Right. Okay. And is it you would say that there's a skill in being able to, I guess, work or build the relationships with people in such a way in order to be able to understand whether they're the right people or the wrong people, and that itself is a skill?
Yeah, there's a skill there. There are obviously lots of psychometric tests, and there are lots of people hanging around in technology that try and help you do that, because hiring the wrong person is expensive, as we all know. I mean, VSS Vaccine Solutions hasn't gone through that process yet, but I'm sure Viagogo, your previous company, had plenty of examples in that. So hiring, but backing the wrong entrepreneur is in many ways worse, because you are bonded to that entrepreneur. You have a relationship, which is the shareholding, where I've given you the money and you can't give me it back and I can't sell it. That's stronger than an employer-employee relationship. And I liken it to being stronger than a marriage, actually. It's easier to get divorced, unfortunately, than it is to actually break the bond between you and I, Steve.
Right, because of the investment, because of the legal.
Yeah, it's not so emotional, obviously, as a marriage would be, but it's still a contractual commitment that's very strong. And you either you've got to be able to sell the business to give me my money back and break the bond, or go bust, which also breaks the bond.
Well, I can assure you, we'll definitely try and do the former rather than the latter.
I hope so. You do it hopefully as well.
So for you, a key part is relationships. Understanding those relationships.
People. And investors, it's not quite the same with employer-employee, but in terms of me as an investor investing in you, it's a trust bond. You've got to trust that I will behave myself as an investor and follow on and give you some more money and not do things that will sabotage the business or cause you grief. And I've got to trust you. You'll take the money and end up doing something with it that's being done, prudently.
I mean, I can say from in my experience that particularly at the early stage, which is where angels operate, they are investing a lot on faith. There's a big bond of trust there that the people that they're investing in will execute what they will give it an absolute 100% effort to execute what they've said that they will execute. And there's a lot of risk on the table for early stage investors, particularly in health tech and life science, which we can kind of come on to.
Yeah, so just on that point, you were sort of lucky and unlucky potentially in that you were particularly well connected. So you have brought money in from people you already knew, the family, friends and fools, they call it. So where the trust bond, not the fools obviously, but the trust bond has already been set up, obviously with family, with friends. That's quite unusual. Your shareholder register has got more people you already knew than most entrepreneurs find. Most of that bond has got to be built up over a period of not too many weeks before investment occurs.
Okay. And have you seen in your without wishing to jump around a bit, but have you seen businesses at an early stage where you felt like they failed in finding investment for that reason? They couldn't build that trust up, or but it was a viable, the business you thought was a really good idea or had a lot of potential, but just they were unable at that very early stage to build enough trust to get the investment.
Oh yeah, I mean, yeah, the numbers are that apparently about in the UK about 600,000 companies are set up every year. About 60,000 think they would like to get some sort of equity investment.
Wow, 60,000 a year are looking for angel.
Yeah. I mean, this might be 2 years, 3 years out of date, and about 6,000, and this probably is a year or two out of date, actually get that investment. That 6,000 probably 3,000 now. The crowdfunding, of course, pushed the numbers up. So there are many disappointed entrepreneurs who just haven't managed to find the funding. So
it's interesting that you measure you mentioned crowdfunding there. So just so everyone listening understands, crowdfunding, there are lots of platforms out there like Crowdcube, GoFundMe. That's another one, isn't it?
There's a huge rationalization going on at the moment.
Consolidation.
And failures. So, for instance, Crowdcube and Seeders have merged into one.
Okay.
Syndicate Room, which I invested in, is no longer crowdfunding. It's a fund manager.
Yeah.
So those are the big three. So the big three become one basically over the last year or so.
And that's because of the problems in the business model, or what?
Yeah.
Okay.
Yeah, the business model, I'm pretty cynical about it from the start. Business model relies clearly, in order to keep the company alive, with transactions. So this means not with success, but with transactions. So it's a transaction fee.
So what they're interested in doing is getting in as much money as possible on an ongoing basis,
correct,
irrespective of the value or potential future value of the businesses that are on its platform.
And that can lead to some bad behavior potentially, where they're pushing forward potential deals. I mean, who knows what it looks like, because it can take many years to get to success or failure, but pushing forward deals just so they can stay alive.
And how much due diligence are you able to do on companies on these platforms? I've not looked into it. We a few people talked to us about it when we founded Vital Sign Solutions, and like you said, we were lucky enough to have connections to a range of different investment sources, which is obviously wonderful. We consider ourselves to be very lucky. So I didn't look at it into too much detail, but I've heard, there are obviously some absolute, from a company's perspective, there are some things that have done extremely well on it, like GoHenry, for example. They which is actually run by an ex-Viagogo alumni called Alex Zavoda, who's done phenomenally well on there. I think they've raised tens or 20, million, something like that. But from an investor perspective, I've actually heard some pretty dicey, sharp behavior or things that have happened that have been less than ideal, it turns out. So what's the kind of due diligence like for investors on that?
I wouldn't like to go into what's happening on that. There's an equity crowdfunding website. It's called Fancy Equity Crowdfunding. Got a guy called Rob who does a lot of investigation into that. But to answer your question, the due diligence is lighter, clearly, than if I or people like me were involved. And although I do recommend it in the book, if you want to become an angel, do a bit on the platform, because you'll understand a bit about
that's your book, The Invested Investor, or is it the second book?
The first book. The first book. Hopefully helping angels become either non-angels or become better angels.
I can say as a founder, both books are excellent, and both books I believe are available right now on Amazon.
Yes, exactly, in audio book, Kindle, and printed form. So just back to your question. So the due diligence is light. It's not done by the platform, because otherwise they'll end up.
They take risk.
They take risk, exactly. So it tends to be done individually, which is fine, which is the same for angel investing. Even if somebody's deal leading, everybody else is responsible for their own due diligence. That's a very important point. You can never blame anybody except yourself if you invest in the business that fails. But this is done, and the best way for somebody who's looking at investing through crowdfunding is to monitor the chat or and the people who ask questions and get replies tend to be the more sophisticated ones.
Right.
Which is the same as with an angel group. That's how I learned, was following other people who knew what they were doing, basically, and learning from them. It's not, you can't codify angel investing because you're investing in a human being with a business, obviously, which has got a long way to run. It's not possible to say, but follow these parameters and you will succeed.
Yeah, because we can switch on to health tech in a second, where I think this question is particularly relevant. But early stage investing often happens pre-revenue. Often,
yeah.
Most of the time, angel investment might be pre-revenue or sort of on that borderline. So you don't have those metrics to say, well, you know, we normally invest at 5x revenue, or that doesn't exist because there is nothing at that point. And I think that for me is massively more accelerated in health tech. So let's talk about, as you see it, what for you, how do you define health tech or healthcare or digital healthcare, or what do you view it like as an investor?
Yes. The answer is I don't know. And it's a change. It's a moving playing field sounds a terrible analogy. It's there are a number of terms that float around in the sector. So I would probably define it as something where the outcome is to the mental or physical well-being of a human being or potentially an animal. So so both, they're both sentient things on this planet. And so I went through my investments. I made about 75 investments, and 14 of them fit in that category.
Okay.
But just out of interest, which you come back onto something later on, none of those have exited. And this is over a decade or so period. There's some are quite recent, and 2 have failed. So proportionately, that's only what 2 out of 14 is 28% or something like that. 40%, sorry. Whereas if you take all the other investments, which amount to about 60 of them, I've had 37% of either, so a third or so of either 40%, no, 25. Get this right. 25.
A bit of paper. Do you want me to write this down?
Yes. They're all on my website, petercowley.org. The point I'm trying to make is that the exits are happening less frequently, and the failures are happening less as well.
Okay.
And this is because it takes longer from the point you first invest to get to somewhere, whether that's product, but it also takes longer to fail. And this is because it takes the journeys take a long time.
And why? And so let's talk about that. Why does it take health tech or healthcare businesses longer to either succeed or fail?
Well, there's a spectrum here clearly between drug discovery, where the product market fit takes rather a long time.
But I would say with drug discovery, so drug discovery for everyone listening is the creation of new drugs from scratch, which could be, for example, the COVID vaccine, but it could be literally any other type of drug or medicine that happens. But I would argue that process is extremely well defined. There is a path to follow for drug discovery that's really well laid out. Do you think?
Yeah, but the cycle length of change is so long. You know, getting into patients, getting them tested and everything. Whereas if you take the example I use is the buy button on Amazon, actually changing that color can be done and tested within seconds, really. I mean, the decision might take weeks, but the actual change and seeing what happened, they can A/B test that. You can't do anything like that in healthcare.
Well, no, you can't. You absolutely
cycle lengths are very long. And secondly, of course, there's a huge amount of regulatory approval required, which both takes data and takes time because the processes are slow. And obviously the risk is high anyway. I mean, the drugs can fail. So that's why it takes a long time. And of course, time costs money because time means paying salaries. Yeah,
and you need, and also in the very, very high, high tech, like I agree with you, there's a spectrum from, on the one end, you might have an app that lets you log your diet, for example, which is really just like data entry, and that might have a nice slick user interface and things like that, but it's not. And then on the other end, you have stuff that's really life sciencey, which is drug discovery, which is like gene editing therapeutics, which is really which is absolute bleeding edge,
Mm.
but takes a lot longer.
Yeah.
Because of regulatory issues.
To go back to spectrum, you've got the ones that might take a decade or more to get into a human being. And you've got the shorter ones, which like the apps, which will, and they are really in principle no different, depending on how the control loop works. So you're collecting data from human beings. What are you feeding back to them? You're feeding back something which just is a simple behavioral change. That's probably no different from a game, effectively. You just need customers. You need to be able to get it out there. You need to find customers. You need to get the customers to pay for it. And then you'll start growing the business, and then we'll end up with either something which is generating enough revenue that doesn't need investment, or we'll get to some form of exit. So yeah, they should, in principle, be no longer than any other form of app. But as soon as you get in this control of anything that's going to affect the human in a way that needs regulating, the whole thing goes out by several years.
So if it takes longer and it takes more money, what is it less attractive to early stage investors, or what is it? What it sounds worse.
Ignoring the risk factor of it might fail at one of the phases or something like that. The two things that really matter to an early stage investor is there going to be enough capital available, not just from us, but from the whole system, to get to the point of some form of exit. And because it takes a long time, it's going to get out of the reach of the pockets of most angels at some point, and we'll need VCs coming in. Will that VC money be able to come in? And secondly, which is slightly technical, is that the VCs come in with some level of preference over the types of shares they've got. And if something goes wrong in that journey, the preferences can actually squash the original angel investor.
Right. So let's just break that down a little bit. So a VC is a venture capital firm. So that means basically there's the sort of I know that they've sort of entered general parlance now because of rockstar investors and things like Uber and all of Deliveroo, all of whom are heavily backed by VCs, which is kind of the acronym, the venture capital. And what you're talking about there with preference is that they have conditions on the money that is invested, and often those conditions are at the expense of early shareholders.
Well, they're only at expense if something goes wrong in the journey. So preference it's a downside protection generally. So if the journey is, and we buy in the UK at least, we buy ordinary shares, which is the same as the entrepreneur has. It's somewhat different in other countries, certainly very different in the States, where even the angels of venture capitalists, even they have a preference over the shareholder shares. The entrepreneurial shares. So if it's going up in a route which is steady and positive, that's fine. But as soon as there's a hiccup because phase one, phase two fails, fails the first round, it needs more money, then the valuation comes down, and that's when the press starts to have an effect on the ordinaries. There's an example here in Cambridge, a guy I know quite well, who sold his business for 100 million and ended up with nothing after 11 years.
No.
Yeah, exactly.
How did that happen? Did he raise money at a valuation that exceeded 100 million and he ended up selling?
No, not at all. Actually, the last round was less than that. It's just that the overall preference stacks raised to 6 different preference rounds, and the final exit was actually just covered everything back.
That's brutal.
No, it was terrible.
Poor guy.
Exactly. He started again. He's on his 4th business now. He's learned quite a lot from that one.
I would imagine that sounds like an absolutely brutal experience. Wow.
Anyway, but don't assume that all VCs causes a happen. It's actually more likely the company will fail altogether, in which case VCs will also lose their money. But it is that you get this funny intermediate state.
So if the investment landscape is bumpier and the outcomes are less certain, there has to be some kind of risk reward payoff. Otherwise, no one would invest in health tech or healthcare. So what is it from your?
Well, again, this depends on where you're on the spectrum. So it's on my website, so I can talk about it. I'm invested in a company called Exonate.
Exonate,
EXONATE, and there's some of this in the public domain. Obviously, I know more than I can say, but we went in. It was a drug discovery company, and I normally wouldn't do this because I don't understand biochemistry or anything. But I know
drug discovery is not your thing.
No, I did know the CEO. I know the chair. They're both after 5 years, and it was and still is working on wet macular degeneration. This is where the retina starts to destroy due to blood supply, apparently. And this is instead of the gold standard, which is a needle in the eye, once in a few weeks. This is droplets. Can you imagine the social outcome from this? Never mind the financial outcome. So, and there's some complicated things there. One, you've got to get the molecule through the eye. When it's through the eye, it's got to do some good and everything. We're several years into the journey. The potential outcome here, and one of the big pharmas is now on the journey with us and funding a lot of the process, is huge. So the risk reward will pay for itself. There's still a lot can go wrong. It's in humans at the moment, but only in small volumes of humans. Who knows? So, but it's, and that was a lucky one because the investment, not lucky, sort of plan. The original people knew this journey would be like this, so they could actually work on the basis that we would ensure that the original founders and angels actually would have a positive benefit.
Right.
But generally, I don't go on those journeys at all. And of course, as I said before, it's a spectrum. And at the far end, which I don't do too many of either, it's I've got one called Psyomics, which is
that's mental, like a diagnostic marker for mental health.
Exactly. It's particularly at the moment always niches aimed at bipolar disorder.
Right.
And it's a combination of a biomarker and an app. And so there's a possibility for biomarker. It doesn't work because it's still under test within the university laboratory here, Cambridge University Laboratory. Then the rest of it, which has got a huge amount of patient data now, will actually be the one that turns into the positive benefit.
Right.
So yeah, it varies, and that will be a shorter lifetime, but it's still got some regulatory, because in the end, what you're trying to do is alter behavior of some form. And this naturally is regulated.
Well, that's why we got into doing, vital sign solutions, which is why we're doing PocDoc, is to try to help people improve their risk of getting cardiovascular disease and type 2 diabetes by having access to tests, having an assessment, and having behavior change all within the PocDoc app. So yes, I completely agree with that. And I think from our perspective, the problems that you're solving within healthcare and health tech are almost by definition global problems, i.e. they exist everywhere. So the market size, the total available market size for these things is enormous. I mean, it's in theory everybody. So cardiovascular disease is the single biggest killer in the UK, and type 2 diabetes, the NHS spends £20 billion a year treating the symptoms of type 2 diabetes, which is completely preventable. So the numbers get very, very, very big. But what you're saying, which I think is, I would agree with, is that the risk along the way is higher. And what you can't do, to your point around Amazon, which is something that obviously, in my previous roles, it was very easy, is just to get something up, functional, get some customers, see what happens, test it. If it works, great. If it doesn't work, you stop it. That doesn't really work in health tech because of quite rightly, the regulatory issues, right? You can't be putting products out there or services out there that have a risk to patients. And then that regulatory really requires you to develop an extremely high level of clinical evidence a lot of the time. So you can't just kind of, in the words of Mark Zuckerberg, you can't just sort of, go fast and break things. It just doesn't work in health tech, because if you do that, you either hurt people or you do what Theranos did, which is, I think, probably one of the biggest, if not the biggest story of the last sort of 10 to 20 years or that I know of somebody or a group of people trying to run a health tech business like a tech business, which was to claim you had something which you don't have, instead of doing the hard yards and actually building it. And I think what's interesting, what's your view on Theranos?
Yeah, that's slightly unfair, because not all tech businesses do promise things that they can't
do.
No,
but you're, that's, sorry, I take your point on that one. What I mean is that you're able to create an extremely high number of iterations of a product and iterate as you go.
Yeah, obviously that's still a piece of, Theranos was still a piece of hardware, which has got a much longer cycle. And I'm quite well known here in Cambridge for doing hardware, because my background's hardware. But many angels won't touch it because of this cycle time. And if it's hardware, it's got a working capital requirement, it's got a supply chain time. So it's the agility of change is much, much slower in hardware than it is in software. Back to the buy button. So can I just segue just there, or maybe hijack slightly, that of course the
hijack away.
What's happening and happened and will happen much more is an overlap between life sciences, health tech, and data. So
Right.
this is effectively ICT, IT, whatever it used to be called or is called. And you pull those together, and then you can have faster cycles. So you're collecting data, you're analyzing data, using machine learning or this term AI, which I think has been hijacked.
Yeah, it gets bandied around quite a lot when it really is.
There's fast behind that. So you've got genomics, biochemistry, data science, machine learning or deep learning. You put that together and you've got a new breed of stuff, which is hugely important.
Yeah.
Because you don't necessarily need to put so much time into the hurdle of checking. I mean, repurposing drugs is a great example.
Yes.
My wife worked for a company called BioWisdom. You won't have heard of it. In Cambridge, formed about 16, 17 years ago, raised well over 10 million, closed in the end because it was probably a decade too early.
Okay.
So this was taking data from public and private databases, pharmaceutical companies, and trying to work out if this drug, I mean, Viagra is a great example there, isn't it? It wasn't being designed to do what it was
designed for cardiac issues.
Yes, exactly.
Yeah.
And it was just because of some miners in South Wales.
So there's a company called Benevolent AI, which you might have heard of, which is doing exactly what you're talking about, which is scraping got terabytes of data about drugs to see where they could be reapplied. And actually, my co-founder, Kieran, that was partly what she did when she worked for Big Pharma, was looking at orphan drugs, looking at repurposing drugs. And it's a huge, huge field, hugely.
Yeah, because you're using a drug that's had efficacy. Well, not efficacy is less important, but safety testing done out already. So you can effectively reuse something from the past in terms of the trials, which will of course shorten the time it will take to get into the human body.
Yeah. So no, I think that's hugely, hugely interesting. And Benevolent AI seems to be doing some unbelievable work in that space. So what does 2021 look like, do you think, for you as an investor or for investors in general? Or what's your kind of view about the future?
The two major changes that we've noticed, one is that new investments have been more difficult because, as I said, at early stage anyway, where there's no data, you can't base it on the metrics of customer acquisition cost, lifetime value. You can't measure it on numbers or anything like that. So you're basically investing in a human being or a team. It's been very difficult to do that through the glass screen of a Zoom.
Do you think that the Zoom issue, or however you want to talk about it, as a result of COVID, is that going to be a block on early stage investing because you can't meet the people? It has been.
Yeah, and in fact, when we had the release to a large extent of lockdown during the summer, at least we could meet in cafes, we could meet going for walks, etc. That made things easier because, as I said, at the very early stage, we're investing in a human being with a business plan in principle, and that's all skill set. So it's a matter of getting to know the entrepreneur and entrepreneurial team, and it's really difficult to work out the dynamics between one or more of an entrepreneurial founding team when they're both in separate rooms in different little screens. You don't see body language, you don't see...
Yeah, that must be really difficult. You can't really assess the chemistry.
Exactly. And because of the potential macroeconomic effects of all the debt that's floating around that we just haven't a clue what it's going to look like, the people have investors, angels and VCs have tended to concentrate more on their existing portfolio and less on new things. So it's actually been a huge, long hiatus, really, for many people in raising finance. They've sort of had to wait, and it's just getting worse and worse. I mean, in the UK, they're talking about basically another national lockdown by the end of the week, or it's some tiered, but it'll feel like a full lockdown. So this is just going to make it more difficult. Of course, there are always silver linings to any change. It's difficult to be that accurate, but I had to go to the GP a couple of days ago, fairly urgently, and the experience I had was massively better than it was pre-COVID time.
Oh, really? Okay.
Yeah, it was.
How was that?
Well, it's because I could, he was willing to, it was happened to he in this case, he was willing to do a voice, just voice, no video, consultation initially, and that happened within an hour of me ringing up because I didn't have to go there and sit in the queue for anybody, and because at that point he needed to do some physical manipulation of something on me to diagnose. I was in within an hour then.
Right.
And this isn't because it's anything super urgent. It's not as if, you know, my leg's fallen off or something.
Okay,
like that.
good to know.
It's not something I'm particularly worried about. But,
yeah, I mean,
and he could take blood. He had to take bloods as well. And you can't do that remotely. We can't take our own blood yet, can we? So,
well, no, but you know, with PopDoc, you can do a finger prick. And
you can do a test, exactly. You can do that, but these were files of blood.
Yeah, I mean, if you need to have a venous blood draw, you need to have someone to be able to do that. Yeah, for sure.
Yeah.
So do you buy into any of these kind of online symptom checkers, the Babylons, the Ada Health? Like, what's your view on that type of thing?
Yeah, I mean, there's definitely a market there, but and I'm not an investor in any of these. I know I have got an account, or rather, I got a free account with Babylon, and I know Ada through a friend here in Cambridge who's on the advisory board of that. Is that the experience I had was so quick in this situation that it makes me wonder whether Babylon, in terms of service delivery using human beings, really is necessary. You've got 111 in the UK, you know, the triage over the telephone. So what it will have is to replace this Googling of your own symptoms with some sort of data-driven decision process. So this is the concept of AI, ML, making some sort of diagnosis. Now, in the end, I think we'd all like initially, it's certainly for the time being, to have voice and a human being making diagnoses. But if you take, for instance, breast cancer screening as an example of where machine learning is almost certainly caught up with humans and will go ahead of them, might even have got ahead of them already, that by processing, because it's a visual thing where you've got poor data, and how many, you know, 60-year-old oncologist who's been looking at these things still has seen a fraction of the number of the
there's a lot of these ML, so machine learning, AI startups or companies focused on different types of cancer now. You know,
exactly. Yeah, and then they need data. They need data of what they've been looking at in the same way as the human beings looked at, and they need data of outcomes.
Yeah.
And you put those together in principle. And I know this is sacrilegious to some extent, both to the medical profession and to probably quite a lot of the listeners here, but it still feels that we're on a journey where the computer in the end will be able to make better decisions.
Or it was certainly, I mean, there's definitely, I mean, I remember when Babylon first launched its sort of symptom checker. I know they call it something else that's a lot more grand, obviously. But they published some data that said it was as good or better than a GP, which caused a huge amount of furore at the time. And this was a few years ago. But
well, rightly so, because it probably wasn't at that point. And so you've got a stack of things there. You've got people's emotional connection with actually visiting the GP and that relationship. You've got the GPs trying to protect their own jobs, of course.
Yeah.
You know, it was too early, probably. But I'm just saying, we're on a journey that feels like we'll get to the point where this is the case. A friend here in Cambridge was CEO and founder of CMR, Cambridge Medical Robotics. This is a competitor to the what's it called, the big one? Just can't remember the name of it. But it looks like he's heading in a direction. I interviewed him from one of my podcasts, and he wouldn't answer this clearly. But it looks like it's on a pathway to get to the. Yeah, I mean, you might want to interview Martin. Just got his CBE actually recently here in the UK. It looks like we're on a pathway to where the robots will be able to autonomously do simple operations. You know.
Wow. Well, that I think that unfortunately that is all of our time. We're up, but it was good. I mean, what's interesting is that this end piece, we've ended on the right note, because my next guest, which is on the Tuesday the 5th at 1 p.m. My next guest is Daniel Rook, and he is the founder of Start Codon. So Start Codon is a Cambridge-based, very cutting-edge tech accelerator, health tech accelerator that's really focused on really like gene editing. So editing genes in order to create new therapeutics, new drugs for some of the most widespread diseases, particularly forms of aggressive cancer. So this is like the very high end of things. And I'm sure that he's got a great view on what we were just talking about. So Peter, thank you so much. Just before we go, do you want to, so it's investedinvestor.com and the books are available on Amazon. Is that correct?
Yeah, so just the two books, one is aimed at angels to become better angels, but in fact mostly read by entrepreneurs who want to work out how to raise money from angels and how to work with us, because obviously we need to work. It's a dynamic situation there. And the second one, Founder to Founders, written by about 100 founders all over the place, who've put snippets of information that we've analyzed to help earlier stage founders make less mistakes, because in the end, you're making mistakes, we're all making mistakes in life. If you can make less of them, you've got more chance of some sort of level of success. And the mistakes you can make, like we were talking earlier on, hiring a very senior salesperson is a really fraught process where it's almost impossible to get the right person. It won't solve that, the book, but at least it'll uncover some of the things I want you to think about.
Perfect. Well, Peter, thank you so much for coming on the Christmas show. And maybe we can get you back on another time, because I feel like there's a lot more for us to talk about.
Yeah, thank you very much.
Okay, thank you.
Thank you. Bye.